Hi everyone, welcome to the channel. In this video, we will try to learn basic account. Because when we listen the word accounting, a question arises in our mind. What accounting is, whether it is a system, subject, activity or a process. Whereas if we talk in broader spectrum, then accounting is a language which covers all the system, subject, activity and process. Just like other language, accounting is a language which is used to communicate and understand the financial information, plans, ideas. So we can say accounting is the language which is used to communicate and understand the financial information, financial plans, financial policies, financial ideas of an entity. Now next question should be, what we do in accounting. In accounting, we summarize the financial information or data into meaningful format or reports. We also remember in a company there are number of transactions, lot of transactions in a day or in a month or in a year. In accounting, we summarize these transactions or these financial information or data into meaningful reports like profit and loss account, balance sheet. What is profit and loss account? Profit and loss account shows the financial performance of a business, okay, in which expenses and income and losses are shown. What is balance sheet? In balance sheet shows the financial position of a business. This is the accounting process. Story in accounting starts with financial information. What is financial information? Financial information may be any transaction, event or a condition. We will see it in detail next. So in accounting process, first of all we identify whether it is a transaction, information is a transaction or not. In the next step, we classify this financial information. Classify in what? Classify in asset, expense, income, capital or liability. Then we record this financial information in the form of journal and ledgers, and then we further summarize this financial information into trial balance, and from these trial balance we generate financial reports, and then we communicate financial or economic results of an entity to the management, to the stakeholders, to the shareholders, You can also understand the accounting process with a diagram. First of all, the story starts with financial transaction or financial information or financial data. We record these financial information into journal and further summarize into ledgers and further summarize into trial balance. And from these trial balance we generate financial reports. As we know that accounting is all about financial information. Now let's see what is the financial information. Financial information means any information which can be made in terms of money and bring change in the financial position of the entity or a business. What is meant by measure in terms of money? For example, you hire a staff, that is not a financial transaction. But when you pay to the staff in the form of salary, that will be a financial transaction. And that financial transaction must bring change in the financial position of the business or an entity. Now let's see what are the sources of financial information. Remember, there are three main sources of financial information. One is transaction, events and condition. Now let's see them in detail. Sources of financial information. The first source of financial information is transaction. Transaction means dealing between two persons and parties having a monetary impact on the financial statements of business or an entity. Transaction is just a dealing between two persons by a business or a person, by a business or a party, in which some transaction involves, something is given and something is taken. For example, sold goods for cash. In this case, goods are sold and cash is received. Purchase goods for cash. In this case, goods are purchased and taken and cash is given. Next source are events. Events are also recorded in business, like loss of inventory by fire and fluctuation gain and losses. And the third source is conditions. What is means condition? What is mean by conditions? Conditions are some adjustments to already recorded transactions. Conditions are some adjustments to already recorded transaction, like provisions for debtors and creditors, provision for discount on debtors. Okay. Next is classification of accounting heads or elements of the financial statement. Viewers, remember these are the most important elements of financial statements. To understand the whole accounting process, to understand the basic accounting, you must understand clearly these 5 accounting heads. What are these 5 accounting heads? Assets, income, liability, capital, and expenses. Remember, dear, accounting revolves around these 5 accounting heads, and these 5 accounting heads are displayed on the financial statement. These 5 accounting heads are displayed on the financial statements, like income and expenses are shown in the income and loss account, and asset, capital, and liabilities are shown on the balance sheet. So these are very necessary to understand the accounting. So let's see them in detail. So first definition is capital or owner's equity. What is meant by capital? Capital is the initial investment or owner's investment of assets in business. It may be in the form of cash or in the form of machinery or in the form of any other assets. Or what is equity? Equity is the owner's share. If there are more than one owner or investor, then it is called owner's equity, owner's share of the assets in the business. Remember, let's suppose you are starting a business. The initial amount which is invested in the business for the start of business is called capital. It may be in the form of machinery, in the form of assets, in the form of cash, in the form of building. Drawings. Drawings are contra to capital. Drawings means money or assets that are withdrawn from a business by its owners for personal use. Remember, dear, drawings are always for personal use, not for business use. Next is revenue or turnover. Revenue or turnover is just total amount received from sales of goods and rendering of services. It is total on our inflow. It is total inflow from sales of goods and rendering of services. Now next definition is income. Income is excess of revenue over expenses. And then loss. What is loss? Excess of expenses over revenue is called loss. If your expenses are more than revenue, that is loss. If your revenue is more than expenses, that will be income. And the next is asset. An asset is any resource owned and or controlled. What is meant by controlled? For example, you have an asset on lease whose control is with you. That will be considered as assets by an entity or a business as a result of past events, and that can be utilized to provide future economic benefits and values to the business. For example, you purchase a building for business, purchase a machinery for business, and purchase any other asset for business that can be utilized to provide future economic benefits. The next definition is expense. Expense is a cost of operation that a business or an entity incurs to generate revenue or income. These are the day-to-day expenses in accounting period. Normally we divide a business into different accounting periods, normally a period of 1 year, to clearly understand the things. It also includes losses of the business. Losses are also expenses of the business. Here are some examples: rent, salaries, wages, utility bills, interest paid, selling expenses, advertising expenses, postage and telegram, freight charges, insurance. These are all the examples of expenses. The next is liability. What is meant by liability? Liability is the present legal financial obligation of the business or an entity as a result of past events. For example, before 2 months you purchase goods on credit. The person to whom you have to give money is your liability. You have to pay. You need some money to pay. The settlement of which is expected to result in an outflow of resources. Now, next is double entry bookkeeping system. Remember, viewers, we use double entry bookkeeping system in accounting. What is this double entry bookkeeping system? In accounting, we record two aspects of each transaction. The recognition of these two aspects of every transaction is also known as dual aspect concept. According to this concept, every business transaction has dual effect. In this system, the total amount debited is always equals to the total amount credited. Remember, dear, in accounting, according to double entry book system, for every transaction there is a debit and equal credit. It means total of debit is always equal to total of credit. That is the basic concept behind the accounting equation, which we will discuss later in our next lectures. So remember, in accounting, every transaction has two aspects. One is debit and one is credit. Now we are going to learn the rules of debit and credit. To learn the rule of debit and credits, we divide our elements of financial statements which we learned earlier into two groups. One is debit group and other is credit group. In debit group there are assets, expense and drawings. And in the credit group there is capital, liability and revenue. So what are the rules of debit and credit? Whenever asset, expenses and drawings are increases, it should be debited. Whenever asset, expenses and drawings are decreases, it should be credited. In the same way, credit group, whenever capital, liability and revenue, whenever it increases, it should be credited, and whenever decreases, it should be debited. What is meant by increase or decrease? For example, you purchase a machinery. First you have one machinery, then you purchase another machinery, then now you have two machineries. It means your assets are increasing. In the same way, you are paying salary 1000, and the next month you are paying further salary. Your expenses are increasing. For example, in the first month, the owner of the business draws 1000 from the business, and then in the next month he also withdraws 1000 more. Its mean drawings are increasing. In the same way, when a person invests in the business, let's suppose 1 lakh is invested, the capital of the business will be increased. In the same way, when you purchase goods on credit, the liability of the business will be increased. When you pay to the creditors, the liability will be decreased. When you sold goods on credit, the revenue will be increased. And for example, you are earning interest from investment, then your income or revenue will be increased in the form of interest received. We can also analyze the rules of debit and credit in another way. Before that, let's see what is the account. An account is an individual accounting record of increase and decrease in a particular liability, asset, income or capital. Account is like that because it is of T shape, that is why it is also called T account. It is just like you divide a paper into two parts. The left side is called debit side and right side is called credit side. And here is title of account. Let's suppose cash account. You have a cash account. The left side is called debit and right side is called credit. Now let's see the rules of debit and credit in another way. One is debit group. As we know that debit group includes asset, expense and drawings. Whenever debit group increases, it should be recorded on the left side of the account. And whenever debit group decreases, it should be recorded on the right side of the account. Debit group normally have debit balances. On the other way, credit group includes capital, income and liabilities. Whenever there is an increase in this group, it will be recorded on the right side of the account, and whenever there is a decrease, it should be recorded on the left side of the account. Credit group normally have credit balance. Okay, thank you viewers, thank you for watching, keep watching. That's all from my side. Take care.